Important update. The IRS has officially set the start of tax filing for 2026. And this year, I need to be very clear with you. The rules are not working the way they used to. They've changed in significant ways that affect almost everyone. Filing too early or filing without fully understanding what changed could delay your refund by weeks or even months or cause problems you didn't expect and didn't prepare for. New deductions can absolutely help you and put more money back in your pocket, but other changes can quietly work against you if you're not prepared and don't know what to look for. And that overlap, that intersection between helpful changes and potential pitfalls is exactly where people get caught off guard every single year. If you rely on your tax refund to cover important expenses, if you want to avoid delays that could affect your finances, or if you simply want to make sure you're not leaving money on the table or making costly mistakes, this matters right now. This is information you need before you file, not after. Quick question before we get going, and I'm genuinely curious about this. When you usually file your taxes, do you try to do it as soon as possible? Like the minute you get your W-2 in the mail or your inbox? Or do you tend to wait a bit, maybe until March or even closer to the April deadline? Let me know in the comments. I'm always curious how people handle this because there's no one right answer. And this year, especially, timing matters more than usual. So, here's what you need to know right away. January 26th is the first day the IRS will officially accept and process tax returns for the 2025 tax year. That's the official start of the 2026 tax filing season. Mark that date on your calendar if you haven't already. And on the surface, okay, that sounds perfectly normal, right? Tax season starts in late January, just like it usually does. We've seen this pattern for years. But what makes this year genuinely different? What makes this filing season stand out from previous years is what's happening behind the scenes that most people aren't aware of yet. We've got major tax law changes that were signed into law last summer and are now taking effect. We've got fewer IRS workers than we had last year, significantly fewer, which affects processing times and customer service. And we've even got a shift in how refunds are paid out, moving away from paper checks toward electronic payments. All of that together, all of those factors combined, makes this season more complicated, more nuanced, and frankly, more challenging than usual. And for a lot of people, for millions of American households, tax season isn't just paperwork and forms and numbers on a screen. It's a major financial moment. That refund for many households is the largest lump sum payment they receive all year long. It might go toward paying rent that's due, catching up on bills that have been piling up, paying off a credit card that's been carrying a balance, or just finally building a small emergency cushion in savings. And with prices still elevated for food, housing, healthcare, childcare, and just about everything else, there's a lot riding on this. Getting your refund on time and getting the full amount you're entitled to can make a real difference in your financial stability over the next few months. Now, one of the biggest reasons, probably the single biggest reason, why this tax season is so different from previous years is the new tax law that President Donald Trump signed last summer. It's officially called the One Big Beautiful Bill Act. And yes, that's the actual name of the legislation. This law made wide-ranging changes to deductions, credits, income thresholds, and various other parts of the tax code. And those changes, all of them apply directly to the taxes you're about to file right now for the 2025 tax year. Some of these changes sound straightforward when you read them in a headline or hear them described in a news segment. But in practice, when you're actually sitting down to fill out your tax return or working with a tax preparer, they add layers of complexity that can be confusing if you're not prepared. For example, and this is a big one that's getting a lot of attention, there are now new deductions specifically designed for certain types of income that weren't deductible before. There's a deduction for people who earn tips as part of their income. There's a deduction for people who work overtime hours. And there's even a deduction for people who have car loans under certain circumstances. Let me break those down for you specifically so you understand exactly what we're talking about. Workers who receive tips, this includes servers, bartenders, hairstylists, delivery drivers, and many others in service industries, may be able to deduct up to $25,000 of that tip income. That's a substantial deduction that could significantly lower taxable income for millions of workers across the country who depend on tips as a primary source of their earnings. Overtime pay, the extra money you earn when you work more than 40 hours a week or beyond your regular scheduled hours, can now be deducted up to $12,500. Again, that's a meaningful amount for people who regularly work overtime to make ends meet or to get ahead financially. For someone putting in extra hours week after week, this could translate to real tax savings. And if you have a qualifying auto loan, if you financed a vehicle purchase, you may be able to deduct up to $10,000 in interest paid on that loan. This is similar to the mortgage interest deduction, but applied to car loans, which is a new concept in the tax code. For families who needed to finance a reliable vehicle for work or daily life, this could reduce their tax burden substantially. And all of that sounds great, right? More deductions mean lower taxable income, which means lower taxes owed or a bigger refund. In theory, this should be simple and helpful. But here's the catch, and this is critical. Employers didn't update their withholding tables after this law passed. The payroll systems that calculate how much tax to take out of each paycheck didn't get updated to reflect these new deductions. That means a lot of paychecks throughout 2025 may not have reflected these changes correctly. So some people, possibly millions of people, had more taxes taken out of their paychecks than was actually necessary without even realizing it was happening. Now, on one hand, that can lead to a bigger refund when you file, which sounds nice. Who doesn't want a bigger refund? But it also increases the risk of mistakes and complications if your W-2 form, the document your employer sends you showing your wages and withholding, isn't reported correctly, or if you claim a deduction that wasn't documented the right way by your employer, or if the IRS systems flag something as inconsistent that can slow down your entire return. And with the IRS running with significantly fewer staff members than in previous years, delays can stretch much longer than people expect. What might have taken a few weeks to resolve last year could take a month or 2 months this year. So, take your time, gather all your documents, make sure you understand the new rules and deductions, set up direct deposit, double-check everything before you file, and don't feel pressured to rush just because filing season opened on January 26th. Knowing the rules this year, understanding what's changed, and approaching this process carefully puts you in a much stronger position. You're more likely to get your full refund, less likely to have delays, and less likely to deal with problems down the road. You've got this, and if you have questions along the way, drop them in the comments, and we'll do our best to help or point you in the right direction. Good luck with your taxes this year. File carefully. File accurately.